You ever feel like investing is just, well, a huge guessing game? Today, we're going to throw that whole idea right out the window. We are opening up the Value Investors Playbook, and I'm going to show you a simple but really powerful framework for making smart decisions. So let's just get right into it. It all starts with this one simple question. Now, I know it sounds like a riddle, right? But this is the absolute heart of a time-tested investing philosophy. How do you find something that is genuinely worth $1 and then actually manage to buy it for half that price? Look, this isn't some kind of magic trick. It's a total mind shift. You have to forget about trying to predict what the market's going to do next. The real goal, the only goal, is to find a truly great business and buy it for less than it's actually worth. So how do we actually find that 50-cent dollar? Let's break down the core idea that pretty much everything else we're going to talk about is built on. Okay, this is the crucial point right here. It's about moving away from speculation and moving towards genuine analysis. You stop trying to be a market timer and you become a business evaluator. You're not just buying a stock ticker, right? You're buying a small piece of a real company. So how do we do it? Well, it's this simple, three-step framework. First, find a great company. Second, figure out what it's truly worth. And third, and this is a big one, make sure you don't lose your money. These three pillars, they are the foundation of every smart investment. All right, now let's really dig into each one of these three pillars one by one so you know exactly what you should be looking for. First up, business quality. This is the foundation. I mean, before you even think about the price, you have to ask yourself, is this a truly great business? And we don't just guess. We measure it by how effectively it can turn money invested in it into cold, hard profit. The key metric we use here is ROIC, which stands for Return on Invested Capital. Just think of it like the company's report card for profitability. It answers a simple question. For every single dollar put into the business, how much profit does it spit out each year? So what's the magic number we're looking for? Well, we're on the hunt for companies that consistently earn more than 15% on their invested capital. And not just for 1 year, but year after year, for at least a decade. A business that can do that isn't just good, it's an elite, wealth-building machine. But a high ROIC isn't quite enough on its own. You also need to look for a strong moat, something that protects its profits from competitors. You got to check the debt. Can the company pay off everything it owes in under 2 years? And finally, is the management smart about how they reinvest profits to fuel future growth? Okay, so once we've found a quality business, we move on to our second pillar, valuation. This is so critical. Because even the best company in the world can be a terrible investment if you overpay for it. So we have to figure out its true or intrinsic value. And this is where the famous margin of safety comes into play. It's such a simple, powerful concept. If your careful analysis tells you a business is actually worth, say, $100 per share, you don't buy it at $100. No way. You wait until the market offers it to you for $70 or $80. That gap, that's your protection. That's your buffer against being wrong. And that leads us perfectly into our third and final pillar, risk management. The number one rule of this game is don't lose money. This pillar isn't about avoiding the normal ups and downs of the stock market. It's about avoiding the permanent loss of your capital. Okay, we've got our three pillars, but how do we actually evaluate a company against them? Well, the answers are all there, hiding in plain sight in the company's own storybooks, its financial statements. Now, I know the term financial statements can sound really intimidating, but don't let it fool you. Seriously, just think of them like the records a local shopkeeper keeps. They simply tell the story of how the business is doing. That's it. And there are three main chapters to this story. The income statement answers, hey, did we make a profit this period? The balance sheet gives you a quick snapshot of what do we own and what do we owe right now. And finally, the cash flow statement, which answers the most important question of all. Where did the actual physical cash go? Now, of these three, the cash flow statement is often called the most honest report. Why? Because it's really hard to fake where actual cash is going. And we're looking for a key number here, free cash flow, or FCF. This is the cash that's left over for the owners after all the bills are paid and money's been reinvested in the business. In a healthy company, you want to see this number growing steadily over time. So we've covered the philosophy, we've covered the tools. Now let's put it all together into a practical checklist you can start using right away. This is the payoff.
This is where the rubber meets the road. We're going to take all that theory and distill it down into a simple set of questions to ask about any business you're looking at. This is how you start your analysis.
All right, here's your checklist. First, check that ROIC. Is this a quality business? Then look at sales. Is it growing or more customers buying? Check the debt against its free cash flow. Is it safe? Could it survive a really tough year? Then look at the free cash flow trend. Is it getting healthier? Is it generating more real cash? Then you check the FCF yield. That's just the annual free cash flow per share divided by the share price. It's a really quick way to see if you're getting a good return for the price you're paying. And finally, look at the 10-year history to see if it's proven to be a durable business through good times and bad. Every single item on this list ties directly back to our 3 pillars. You know, it really all boils down to this. If you can avoid these 3 critical mistakes, you stack the odds of success way up in your favor. Did you overpay? Is the company just drowning in debt? Is its competitive advantage disappearing? Almost every single permanent loss in investing comes from one of these 3 failures. Burn this into your brain.
And there you have it. That's the playbook. The framework is simple, but it is incredibly powerful. This isn't about being a genius, it's about being disciplined. So the only question left is, which business are you going to put to the test first?